Good morning, everyone. My name is Corey Hoffer. I'm with Hermitage Wealth Management. Today's August 31st, and we've got a special speaker in Bryce Gill at First Trust with us this morning. Bryce is presenting this morning from his home in Austin, Texas. He did his MBA at the University of Texas and his undergraduate work at Miami University in Ohio. And he's part of the First Trust economics team, which we're really excited to talk to this morning. That team has been ranked top of the class by Bloomberg for some of their economic forecasting, as well as they've been ranked #1 for some of their commentary over the years with respect to thought leadership. So Bryce, welcome, good morning, and I thought maybe you could tell us a little bit about what you do on the economics team at First Trust.
Absolutely. Well, hey, thank you so much, Corey, for having me. It's great to be with you this morning and with all of your clients. And yeah, I've been at First Trust now for 10 years on the economics team, and really that role has kind of evolved over time. I used to be much more focused in-house, kind of doing research and writing and dealing with compliance and answering questions, and I still do all of that. But now I've really kind of transitioned much more towards public speaking role. So I'm out on the road pretty much every week, different parts of the country, in person, doing presentations and talking about all the craziness that's been going on out there in our economy recently. And man, there's been some stuff for the record books over the past couple of years for sure.
Yeah, I'm sure you've had no shortage of things to talk about as you make your way around the country. So, well, thank you again for being here. And I know your presentation this morning is titled Volatility Has Arrived. So with the accolades that you guys have collected with respect to your economic forecasting, I'm hoping you could tell my clients and me where we're headed, or maybe at the very least when that volatility stops.
Yeah, well, it's funny. I made my presentation, the title of it, Volatility Has Arrived, like a year ago. And I don't think I'm going to be changing it anytime soon because, here we are. We just had a big bear market rally. The market seems to be kind of correcting again. My best guess is, hey, how do we get into a new bull market? How do we get back to the good old days of just consistent returns every single year? We got to get inflation under control. We got to get back to 2% inflation. And, while there's some good reasons to be optimistic here in the short term, we're going to make some progress. I think getting back to 2% in the long term is it's going to be a challenge for sure.
I mean, it almost seems like an impossibility at this point after these, 7, 8, 9% prints. But let's tell us a little bit about kind of your take on that and moving into sort of the money supply side, which we don't really hear a lot about in the general news media.
Yeah, absolutely. And, Corey, obviously we're kind of proud about the Bloomberg rankings and, we have accolades that we're proud of that we talk about. But really the main one that I think I'm proud of is that we were really early on calling this inflationary surge. Back in, March, April, May of 2020, we were saying, hey, this time is going to be different. Inflation can make a comeback. And it really was based all around this idea of too much money chasing too few goods. And I think, that's a great segue for that first slide on M2. The idea of looking at the money supply, this almost became like lost knowledge in the economics profession. People thought that the supply of money did not matter anymore. And it really came down to, well, hey, we printed a lot of money after 2008, 2009. A lot of people were calling for hyperinflation. We were not one of them. And the reason why was, well, hey, yeah, the Fed printed a lot of money, but it never made it into people's hands, right? And that's why we like looking at this measure of M2 money supply, okay? It's dollars in people's hands that are very likely to get spent on a commercial transaction. So unless the money's in people's hands, how can it bid up the prices of goods and services, right? And if you look at 2008, 2009 on this chart, and by the way, this is just the year-over-year change in the U.S. money supply. Sure, we were printing a lot of money at the Federal Reserve, but we just gave all that money to the banks. They put it in excess reserves. They used it for capital ratios under Dodd-Frank. There was really no notable increase in the dollars in circulation that people actually had access to. And so if you look at 2020 and 2021, it's obviously a completely different story, right? The growth rate in the money supply is the fastest we've ever seen in modern U.S. history. And that's because we printed $5 trillion and we sent out checks to everybody, right? We completely bypassed the banking system through stimulus checks, boosted unemployment benefits, PPP loans. So, that old saying, too much money chasing too few goods. Hey, not only was there too much money, but we also locked down the economy, massively disrupted production. So we blew both sides of the same. Now, I mentioned how this slide is actually kind of encouraging to me, or, at least I'm kind of a short-term optimist here on inflation. And I do think we're going to see progress here in 2022. And it really comes down to the fact that, hey, the growth rate in the number of dollars in circulation has rapidly returned back to what is basically normal. That's that 60-year average there on the screen, right? So, there's been a huge tailwind to inflation from just more dollars being out there. That's rapidly come to an end as we've stopped sending out stimulus checks, we started raising interest rates, normalizing monetary policy. Now, I will say there's a couple states out there, like I think California and most recently Pennsylvania yesterday is talking about sending out more stimulus checks to offset inflation, it's really Weimar Republic type stuff.
Mm-hmm.
So, I wouldn't say we're completely out of the woods, but, I haven't been, necessarily that surprised that, for example, CPI started to decelerate from that 9% rate, the data we got last month. I think we're going to get some more numbers going forward that are encouraging. I think we can get back to 6-7% CPI by the end of this year. That's a realistic kind of outcome, but it's going to be really tough getting back to 2% anytime soon.
Absolutely. Absolutely. And so really interesting on the M2 side. Why did we get away from M2? And why is it sort of a lost art? And why is it no longer talked about?
Yeah. So, part of it is, okay, when you look at a lot of the economists out there, and I am self-critical about the profession, 80-90% of economists work in the government or they work in academia, which is very well connected to the government. And so, hey, the more money that we print, the more we enable government spending. I think that's one of the Fed's real dual mandates is to, make the government debt affordable. And so, yeah, anytime it comes down to printing a lot of money and enabling government spending, you all of a sudden have a lot of economists that, stick their head in the sand because, they want to get hired by the senator that they work with, or, they want to get hired at that think tank in DC. And, part of it too was, again, the Fed printed a lot of money after 2008, 2009. If you just look at like the Fed balance sheet, it went up a lot, but inflation didn't. So I think to some extent there was also just, a misunderstanding about which measure of money you should probably look at. M2 was actually invented by and popularized by Milton Friedman back in the Paul Volcker era.
Yeah.
And obviously Milton Friedman, he's kind of like a small government type guy. So again, another reason why he's probably not going to be in vogue in Washington, D.C. So if you had to ask me, that would be my kind of best guess about why all of a sudden, hey, the supply of money doesn't matter, which is, obviously just not true
Right.
on its face.
Absolutely. Yeah, but it creates some interesting insights when you look at the data, no question.
Absolutely.
Yeah. So where does that take us in terms of where we're headed from a globalization standpoint?
Yeah, absolutely. And, this I think is the biggest challenge. So, getting back to 6-7%, we'll make progress this year, but how we get back to 2%, I think that's going to be where the big challenge is. And the real, I think, fly in the ointment or the big challenge that we face, it comes down to globalization. Okay. And so what I've got on the screen here is I've just added up imports and exports. I've adjusted that number for the price level for inflation. And so the best way to think about this line is it's the actual amount of goods crossing the U.S. border, or really, I just think about this as globalization in one line. Okay. And this goes back to 1960, but really since the end of World War II, globalization has been on a long-term upswing. I mean, this has been the most secular and long-term of trends in the U.S. economy. Listen, there's obviously downsides to globalization, right? It started out with not being able to buy toilet paper, and today it's baby formula, or you've been waiting for a couch for 6 months or whatever else, right? So there's definitely downsides to having these really long supply chains. But what's the upside to globalization? It's that it makes things cheap, right? And the way it does that is, hey, you get to take advantage of less expensive labor and materials abroad for production, right? And so I really look at globalization as this long-term force that's kept a lid on prices for United States consumers for a really, really long time. And you can see that on the chart, right? It's been rising for 70, 80 years, pretty much consistently. And by the way, this comes to an end after 2008, 2009. That secular trend kind of hits a wall. It's been plateaued ever since. And just thinking about the last couple of years, I don't know how globalization doesn't fall. Okay, are we going to fall back to like 1960 levels on this chart? No, right? That's very unlikely. But I think we are going to see it decline to some extent because, hey, the entire business model of globalization has essentially been upended by the COVID pandemic.
Right.
These supply chains, it makes a lot of sense to produce something abroad and import it for less money. You boost your profit margins, consumers get a lower price. There's a lot of winners. There's obviously losers too, but on net, there's a lot of benefits from doing this. But that only works as long as you can reliably load a ship on one side of the planet and offload it on the other side of the planet on time in this really efficient, inventory and supply chain system. And all of a sudden, when you have a rolling series of public health lockdowns like we've had over the past few years, and I know here in the United States, this is kind of behind us, but keep in mind, China, our biggest supplier, is having consistent lockdowns still to this day. And so, hey, if one factory in that supply chain shuts down, well, all of a sudden, the rest of the supply chain gets completely disrupted, right? Classic example is you got a bunch of completed Ford F-150s sitting on a lot just waiting for one semiconductor from Taiwan, right? Yeah. So, and that's every good in the economy. So you're starting to hear a lot more talk about reshoring manufacturing, bringing some of this stuff home, shortening supply chains. And strategically, I think that's the right thing to do. No question about it. The status quo cannot continue post-COVID. But I just think it's important for people to understand, it's like globalization's been this reliable force that's made things cheaper for so long. If we see that decline to some extent, there's going to be a cost to that, right? It's going to keep inflation elevated. It's going to make things more expensive. Now, I think America at the end of the day will be better off for this. But during this transition period, while we reindustrialize and kind of bring some of this stuff home, it's going to keep inflation elevated. So my best guess here is 4 or 5 years of 4 or 5% inflation. A lot of it is just, we call it supply chains, and that's not untrue, right? But really what it is the status quo in the global trading system has been completely upended by these public health lockdowns and COVID-19 in general. And so we got to rebuild this whole system in a more resilient way.
Sure. I mean, you're talking about a 50-year trend that has had arguably a positive impact, a net positive impact on inflation for that period of time. And should that trend come to an end, or even, that trend sort of go sideways for a while, moderate for a while, you've got to expect an increase in inflation and maybe a sort of a new normal type of number. However, what we're hearing from the Fed is that they're kind of hard fast at this 2% inflationary target on a going forward basis. Do you expect any adjustment on the behalf of the FOMC to sort of recast some of that forecast or target?
Yeah, so it's a great question. And that's kind of the crazy part about the situation that we find ourselves in is in the past, people have looked to the Fed as kind of the savior to step in and deal with the inflationary problem. But, the Fed, frankly, has no ability to affect global supply chains or lockdowns in China or the war in Ukraine or the global trading system in general, right? So a lot of our biggest problems are kind of outside the Fed's control at this point. I'm glad they've slowed down the growth rate in the money supply. I'm glad they've normalized interest rates. But I think, eventually we're probably going to see the Fed raise its inflation target. My guess would be from 2% to 3%, at some point in the future here.
Right. Okay. Interesting. Well, very good. So we've got that kind of to be determined, I guess, but something important to watch out for. We find ourselves in sort of this three bear scenario right now where we're in a bear market in stocks as well as bond as well as cash. We're hearing a lot on the news that we're in recession, and I think a lot of the news on a going forward basis is going to be highly politically charged up until these midterm elections. But this word recession is being thrown around a lot lately. And so from a technical standpoint, we've had 2 quarters of contraction after, phenomenal rebound quarters in 2021. Where do you think we are right now, and how would you position the particular recessionary environment, potential recession that we find ourselves in right now?
Yeah, absolutely. And I think for 99% of people, when they see 2 consecutive quarters of negative GDP, that's a recession. And so I'm fine calling it a recession. But what I'd like to point out to people, especially as investors, is how weird this recession is. Okay. And it's not what you would normally expect to see in a lot of different ways. And my favorite way to talk about this is through personal income. Okay. And so that's what I've got on the screen here. Personal income in blue. So wages and salaries, dividend income, rental income. That blue line is an aggregate for the whole United States. And then I just created a long-term trend line there. So we have a basis of comparison. Where would we be if we just grew at kind of the long-term average in perpetuity? So it's not realistic, but it's just, again, it's to compare it to. And if you look at 2008, 2009, you see what happens in pretty much every recession in U.S. history, which is, hey, millions of people lose their jobs. When you're not working, you no longer have personal income. If you don't have personal income, you're probably not doing consumer spending. If you're a business, you're not going to invest because, hey, there's no demand in the pipeline for your product. And so it's the classic downward spiral, right? And you can see that personal income falls. It stays below the long-term trend line for like 10 years. Which, by the way, is why that recovery felt terrible to everybody. It was the slowest since the Great Depression. So, all that aside, if you look at 2020 and 2021, personal income in the United States never fell during this pandemic, nor has it fallen in this current, 2 consecutive negative quarters that we're currently in, right? In fact, it's surged multiple times. And keep in mind, we lost 24 million jobs during the height of the COVID lockdowns. That's 3 times what we lost in 08, 09. So this is a pretty crazy chart when you think about that. And a lot of people thought, hey, these stimulus checks stop going out the door. Personal income is going to rapidly fall back to that trend line, along with retail sales and consumer spending and, corporate earnings. And that just hasn't happened. No way around it. Personal income is still way above that long-term trend line. And it's growing consistently. You can see that on the chart here because we're adding back a lot of jobs. Wages are rising. And so that kind of brings me to, hey, no question about it, GDP has been negative. But then you look out there and say, hey, the first 2 quarters of 2022, we added back 2.5 million jobs. Personal income has continued to rise. And, by the way, guys, as an investor, what I really care about isn't the technical definition of recession. What I care about is earnings falling, right? That's mostly why we care about recessions in the investment industry, is because corporate profits fall. And corporate profits, along with interest rates, are the 2 big variables that go into financial asset valuation. And so, hey, we got Q2 corporate profits for the S&P 500. They were up like 7% from a year ago. So profits are still rising, incomes are still rising. We're adding back jobs. This is the weirdest recession that I've ever seen. And, frankly, maybe that shouldn't be that surprising given that, this pandemic that we came out of, I don't even like calling that a recession. It really wasn't. We didn't overinvest in one sector or another and, the bubble popped, right? It's like housing in 2008. And we have to reallocate all these people and resources to better uses. It was really a suppression, not a recession, right? We suppressed economic activity for public health reasons. Now we're in the recovery period. We flick the light switch back on. Maybe we shouldn't be so surprised that some of these traditional measures, are coming in surprising ways as well.
Yeah, I would agree. Absolutely. And so we've got this situation where you show the rising personal incomes. You mentioned wage growth as part of that as well. So obviously it's got to be where that increase in personal income is coming from. Wage growth, we know, can be a scary thing because it can exacerbate or perpetuate inflation. And so, what does the Fed do? I mean, it seems to me right now they've got to kind of walk this narrow line of trying to sort of slow things down, right, to prevent some of this wage growth trend from continuing, yet at the same time not put us into a hard landing. And I guess after last week's comments when the Fed met out in Jackson Hole, I mean, they drew a pretty hard line, it seemed to me, to remain hawkish. But where does, how does the Fed deal with this situation on a going forward basis?
Yeah, I think that this is the big debate because the Fed has, publicly a dual mandate, right? They care about price stability and they care about employment. Now, I would make the argument that over the years, hey, we're in the Paul Volcker period. They cared a lot more about inflation than employment. They caused 2 recessions in a row to deal with that problem. Today, I look at the Fed and I say, man, I think they care way more about employment than they care about inflation.
Sure.
And so my guess is I think the Fed will keep hiking rates here till the end of the year, maybe, once next year, and then they're going to stand pat and just let rates kind of sit where they're at and observe what happens with the labor market. And it's pretty easy to keep raising interest rates from the Fed's perspective when you're getting employment reports like we got last month, where we got twice the consensus on non-farm payrolls.
Mm-hmm.
What happens when we actually start to see the labor market weaken? I think that's the biggest open question out there. Yeah. My guess is that's where you eventually see the Fed pivot in some form. And so, yeah, I look at the Fed as very dovish, frankly. And, that shouldn't be so surprising because there's a lot of parallels to the 1970s. And you guys have a great chart up here that I love to use to talk about this, which is the US dollar index. There's tons of parallels, right? I mean, there's geopolitical problems, energy prices are surging, inflation's at a really high level. One president got impeached and got replaced by another president that everybody perceives as weak, right? That's like the Nixon and Carter comparison. So there's all kinds of parallels, right? But one thing is kind of the polar opposite, which is the strength of the US dollar, okay? And if you look at, and this is the US dollar index from Bloomberg, it just compares the dollar to other major currencies. If you look at the late 1960s to the early 1980s, when Paul Volcker starts his rate hikes, the dollar is collapsing by like 30 to 40%. And it's doing that for a good reason. We were administering the gold standard for the world at the time. We took advantage of this position. We printed money to pay for Vietnam and the Great Society under LBJ. Eventually, the Europeans kind of get wind of this, specifically France. They want their gold back. And at the time, gold was pegged at like $35 an ounce, right? So there was no way we could make all the redemptions. Fort Knox would have no gold left in it. So President Nixon closes the gold window. We end the gold standard. We enter into a fiat currency standard we've been under ever since. This is all terrible for the dollar's reputation. The dollar is collapsing. And I've gotten so many questions about the reserve currency status of the dollar. Is the reserve currency ending over the past 10 years or so? This is a period where the reserve currency was actually at risk of ending for the US dollar, okay? And so inflation was no question a part of the Fed's decision back then to raise interest rates up to a peak of like 20%. But in my opinion, okay, I think the bigger thing going on was the Fed needed to rescue the US dollar's reputation, and they were willing to sacrifice the real economy to do it. Notably manufacturers, farmers, home builders, right? And you can see it works on this chart. The interest rate hikes start, the dollar index hits its highest level ever. So I give the whole history lesson to say, okay, we're in another inflationary period. We like to compare it to the 1970s. The US dollar is not collapsing today. The US dollar continues to hit new 20-year highs almost every single day. And if I had to put my finger on it and say, what is the one big difference? One is, hey, we didn't go off the gold standard, obviously, right? Which, by the way, hey, the price control ended after like 30 years and gold goes up 1,300%. So that's kind of the basis behind that huge surge in gold that everybody talks about. But the other big one was energy independence, okay? Back in the 1970s, we had the oil embargo. We had a huge shortage of energy. Oil prices quadrupled in the United States. We did not have enough domestic supply to support ourselves. And currently, if you look around the world, there's a region that's having the exact same thing happen right now. It's not the United States. We're currently a net exporter of energy. We have enough energy to supply ourselves. It's the European Union, right? They got heavily reliant on Russian oil and gas. And now, due to the invasion of Ukraine, Russia is using energy and food as a weapon and cutting them off. And it's basically sent their economy into an inflationary spiral, just like the United States was suffering during the oil embargo. And so the dollar is surging, frankly, because the euro is collapsing. They're going through what we went through in the 1970s to a certain extent. And so, there's a lot of parallels again, but the US dollar is doing extremely well. The reserve currency, the status of the dollar is the strongest it's been in 20 years. And so the urgency to bail out the reserve currency status of the dollar that existed in the early 1980s, that doesn't exist today, right? Which is why, for example, you see, hey, I get it. We've hiked interest rates very rapidly, right? We're probably going to get to 3-4% by the end of this year. And that's a lot of rate hikes in 1 year from a historical perspective. But hey, it's also way below inflation still, right? It's negative real interest rates no matter which way you cut it. And so that's still loose monetary policy from a relative perspective. This is not Paul Volcker. And that's because, hey, we don't got to bail out the US dollar this time.
That's interesting. So the Fed's got sort of, a lot more tools theoretically in the toolbox when you parallel it to periods similar to what we've been through in the past.
Yeah, and think about it this way, right? There was a country that Paul Volcker returned to recently. It wasn't the United States. It was actually Russia. Russia, after the sanctions, the ruble collapsed by like 60%. What's the first thing their central bank did? They raised interest rates to like 20%, just like Paul Volcker did. This is a classic tool in the toolbox that central banks use to protect their currencies. It's just not warranted for the United States currently.
Right, absolutely. Very good. Well, tell us about kind of the new Inflation Reduction Act and what your take is on that.
Yeah, well, the Inflation Reduction Act is not, geared around inflation at all, really. It's just the Green New Deal or Build Back Better that's kind of been rebranded. The heart of the bill really is investments in green energy technology. I think about like $300 billion.
Yeah.
And then certain other measures to raise revenue to offset that cost, right? So things like hiring the 87,000 IRS agents, a minimum tax for corporations, for example. So, really it's a green energy bill. And the administration, after they passed it, they pretty much abandoned even trying to call it the Inflation Reduction Act, right? They started calling it the biggest climate investment in our generation. So they don't even think it reduces inflation. Their one argument was, hey, it reduces the deficit by, I think it was like $300 billion or whatever their estimates said, which aren't going to be true.
No.
But, the flip side is, hey, we just did student loan forgiveness. I'm going to assume this doesn't get struck down by the courts. I'm not a legal scholar, but on its face, student loan forgiveness is going to cost like $1 trillion. So it's going to more than 3 times wash out whatever savings could have potentially happened from the Inflation Reduction Act. So it shows you that nobody is very serious about this problem in Washington, D.C.
Yeah, and to I know we're getting close to our time with you, so I want to talk. We've got some questions about the student loan forgiveness program. Can you just kind of give us the bullets on that to finish us out?
Yeah. So the headline thing that everybody's talking about is $10,000 of loan forgiveness for, I think, individual borrowers that make less than like $125,000 a year.
Yeah.
So $250,000 if you're married. And, I get why that's capturing all the headlines, but I want to make clear to people that that's actually not even the bulk of the cost that's coming along with this bill.
Right.
Really, the bulk of it comes down to income-based repayment plans, okay? And so what the administration is saying is your monthly student loan payments that you have to make are now capped at 5% of your income. So, in the past, hey, you have this minimum payment you have to make, otherwise the interest is accumulating, right? Now it's just, hey, 5% of your income, that's all you got to make. And the rest of it is basically gravy and it gets forgiven after 20 years. So this is a pretty radical policy. And
It's
what it's
pretty.
going to mean is, hey, why would I borrow anything less than the maximum loan when I'm going to college? You might as well max those loans out. And worst case scenario is you got to make a 5% payment on them. No one is ever going to pay off their loan balances. All this stuff's going to get forgiven. That's where the bulk of the cost in this bill is coming from. So it's pretty interesting to see. But at the end of the day, it's going to mean, hey, more student loan debt, higher tuition bills, and a lot of cost for the U.S. taxpayer.
Yeah, I mean, it seems, I guess, one perspective, I mean, it's almost like the universities, colleges have an open opportunity to increase tuitions at will, right? Knowing that there's a guaranteed income stream to pay off that debt eventually.
Yeah, absolutely. And, I think that they're kind of playing with fire here, right? There's already kind of this big political backlash happening against the universities. Obviously, they have a political agenda in a lot of cases, right? And so, hey, half of the country sees them as, if not like an outright enemy, at least just not on their side, right? And so, man, doing this, I mean, this is like you're just stoking another giant backlash against the universities. I don't know if this is going to be in the form of explicit caps on tuition or explicit regulations on what kind of degrees they can give or taxing endowments, but there's going to be a kind of some kind of reaction that's not going to be in their favor from this. That would be my prediction.
Very good. All right. Well, Bryce Gill, thank you. Thank you for your thoughts and your comments this morning. We covered a lot of ground there, from the kind of GDP to the Fed and where we are, M2 money supply, all the way out to the Inflation Reduction Act and even student loans. So we appreciate your being here. We appreciate your thought leadership, and we'd love to have you back sometime in the future.
Absolutely. I would love to come back. It was great speaking with you this morning, and have a great day, everybody.
Thank you, Bryce. This concludes our presentation. We encourage you to call in, email in with your questions or comments. We'd love to hear from you. Thank you.